Hello and thanks for tuning in. I'm Holly Shields for Kalkine TV. Welcome you all to another edition of Executive Corner Expert Talks. Now, we know that startup has been a huge buzzword in the business world over recent years, and the industry is continually expanding. However, it's not always easy to determine the prospects and investment opportunities in the startup ecosystem. So to help us understand it better, today we're joined by an expert from Early Metrics, a company that engages in the startup ratings and research to empower a changing economy, while providing the right open innovation tools for decision makers from funds and corporates to discover, qualify, and engage with the best innovative startups. Jean Jerian is a partner with Early Metrics and oversees the UK and international markets. Welcome to the show, Jean. It's great to have you on.
It's a pleasure to be with you. Thanks for the invitation.
Thanks for joining us. Now, first of all, as we're going through a period of economic uncertainty at the moment, it seems even riskier for corporates and funds to partner with or invest in startups. Where does Early Metrics come in with this and potentially solve this issue?
So naturally, the startup ecosystem is much more risky, right? And that has obviously also changed or been amplified over the last 2 years because of the pandemic. However, what we've seen actually is that the VC capital investment into startups has actually doubled over the last 2 years. And then on top of that, we've seen another trend, which is actually that a lot of governments have started to lend more money and also buy banks to startups. So why is that? First of all, VCs have started to sort of support their portfolio companies in 2020, and in 21, they started to invest into new startups, right? So that's why we've seen more mega rounds lately. And then on the other side, we've seen banks and governments starting to support essentially startups in 2020 with those recovery loans, for instance. So naturally, as I said, risk is always there when it comes to startups. But because there was more and more demand, banks, investors, governments were facing a new dilemma, which was how can we cope with all of this inflow of applications and demand for new money? And that's essentially where we come in, because we've helped those institutions essentially to cut through the noise and identify the ones with the best or the most promising growth potential essentially. And this can be done through our software ScaleX, where we automatically are able to rank and benchmark and assess the growth potential of startups. And we help essentially those investors and banks and governments to make more efficient decisions when it comes to investing, when it comes to deciding who's going to get the money and who won't get the money.
Right, excellent. That's very wise decision there. I'd like to know what's the criteria when it comes to assessing these startups that you use?
That's a great question. So traditionally, if you ask an M&A team, they would look at financials mostly, because if you look at a public company like Apple, for instance, you've got broad or long history of the finances and the balance sheet, etc., etc. This doesn't apply to startups. So what we have essentially developed is a rating methodology that purely focuses on the non-financials of startups. Because at the end of the day, what matters most to startups is not the idea only, it's the founding team, it's the founders who can really drive and pivot if needed and make this a success. So we initially, back in the days, we've been around for like 8 years now. Initially, we looked at, we did an interview process and we analyzed and interviewed the startup founders. Obviously, we've evolved because the market has evolved, and our, let's say, traditional rating methodology has inspired us to create a software to be able to cope with bigger volumes, because that's what the market needs and that's what we've developed. So we essentially have an algorithm that analyzes startups based on the survey, for instance, and we can essentially predict the growth potential of that startup and also the likelihood of bankruptcy. And we can give our investors and clients specific signals whether or not or how likely it is, for instance, for a startup in an early stage to actually reach IPO stage. Because at the end of the day, as an investor, that's what you want to know, right?
Absolutely. It's incredible that you're able to quantify that information as well. How accurate would you say it is in the long term? Do you see that accuracy manifest, as it were?
Yeah, it's a question I get quite often, to be fair, and that's why we've have a methodology team which essentially backtests our data. And what we've seen is that there's a strong correlation between our ratings and the success or bankruptcy risk of a startup. So in a nutshell, without throwing around too many numbers, if you look at the bell curve, like startups, and we have a rating scale from 1 to 100, and startups with a rating above 75 have a likelihood of strong growth above around more than 80%, 83% if I remember correctly. So there is a strong correlation. This is based on thousands of data points we've looked at already, because we've been around 8 years now. So we have a lot of startups to look at and a lot of data to look at together.
Right, I can imagine that's the case. You've obviously honed your expertise there, which is good to hear that you definitely know what you're talking about. And now I'd like to ask you,
Exactly.
in your opinion, Jean, how can businesses achieve innovation? Because we know that's obviously very key when it comes to startups. How can they achieve innovation through external partnerships?
That's a great question. So if I look at innovation, I'd like to define it first. So innovation means, or sustainable innovation, for instance, what does it actually mean? At the end of the day, it should create value for shareholders, but also in the current days, we're moving away from the shareholders principle towards also creating value to society and the environment. So those are the things we need to look at, and those are the things investors need to look at increasingly, and also corporates. So now I would like to look at external partnerships from a corporate or investor point of view and from a startup point of view. And I'm going to sort of give a life quote here. So at the end of the day, no matter who you are, when you marry someone, when you enter a relationship, you want value added to your life. Otherwise, you would never enter a relationship, right? And this is the same, or this applies to startups and corporates as well. They would never enter a relationship if there's no value add for either side. Right. So how can a corporate get value from a startup and vice versa? Or an investor, CVC, for instance, corporate venture vehicles of corporates. So first of all, corporates are like big oil ships, right? Like oil tankers. They are huge. And then on the other side, you've got startups, which are a bit more agile. They're a bit like a speedboat, right? So if you want to get like a huge cargo from A to B, you wouldn't take the speedboat, you would take the big oil tanker, right? If you want to get quickly somewhere, you take the speedboat, so the startup. So how does this relate to synergies and value add? Well, the corporate can offer certain things to the startup, and the startup can offer certain things to the corporate. For instance, the corporate can offer a lot of expertise, a lot of experience, a huge market to tap into, while a startup can actually offer agility, disruptive innovation, and also, I'd say, cultural advantage in terms of risk and being fearless. So those two have, at the end of the day, they have a similar goal, but they're at different stages, right? An Apple, a Tesla, they were all startups initially as well. So once a corporate has identified a startup that has found a new disruptive solution, usually corporates can engage with them through partnerships or investment via corporate venture vehicle, for instance. And this is where the synergy creates or is created, and a partnership can actually create long-lasting innovation. Because once a corporate identifies a startup, they approach the startup, they start working together without integrating the startup into the corporate, which means the startup can still pretend to be a startup.
Right.
Exactly. It can still do its own thing, work and act independently, while reaping all the benefits of working closely with the corporate, being introduced to a bigger market, maybe piggy riding, is that the word? Like leveraging the brand of that big corporate, etc., etc. So at the end of the day, this is sort of how any relationship works. Both sides have sort of bring value to the table. And we've seen it with, we've worked with 250 corporate clients, most of them Fortune 500 clients. Once these two parts of the market, of the ecosystem, start working together, we've seen huge successes, especially, and I should mention that as well. Most of the corporates, they focus on incremental innovation, while startups, they focus on disruptive innovation. So they have the biggest potential to sort of disrupt the market, and the corporate can leverage this and benefit from this. That was a long answer, actually.
Right, no, that makes perfect sense. It sounds like it's definitely about a win-win there for both the corporates and for the startups.
Exactly.
Now, I'd like to ask you how that startup ecosystem is faring at the moment. Is it thriving under these market conditions?
If you remember what I said at the beginning, there were two big initiatives that have happened. It was essentially the VCs support, or CVCs, VCs, corporates supporting the existing portfolio companies, and then the government stepping in and supporting startups with recovery loans. So actually, the ecosystem started to thrive rather than sort of rotten away. And we've seen it now. We've seen it in 2021. We see it in 2022 already. There are so many mega rounds and unicorns. Also, mega rounds meaning hundreds of millions actually being given to startups. So, like in Series A, Series B, Series C, Series D, the average ticket size is steadily increasing, and the valuation of those startups as well. And let's say 5 years ago, the term unicorn was meant actually something, it was special. Nowadays, we see so many unicorns. It's actually, we're looking for a lot of investors, and also the media essentially is trying to find a new buzzword or like a new description, because a unicorn is not unique anymore, essentially. So overall, the market has thrived, that's for sure.
That's fascinating. I mean, it's obviously very good news for you.
Yeah, it is. We've seen an increase in activity, but I want to make a distinction here again. So, and I think that's something which I found fascinating over the last 2 years. We've seen essentially 4 observations, right? So we've seen that the VC money that has gone into the market has increased. I think a ridiculously high amount by 108% year over year, 2020 to 2021, and we're expecting another huge increase in this year. Then, of course, we've seen the corporates who are also part of this innovation ecosystem or startup ecosystem, but there we see a very much like a binary view or picture, because we see corporates, or we've seen corporates in sectors that have been hit hard, who essentially used it as an opportunity to create long-lasting, sustainable innovation. So we work with a few airports in Europe, and we actually help them to identify new disruptive solutions to sort of gain a strategic advantage over some of the other airports. So we're talking about air taxis, for instance, air cabs. How can the airport be connected to the city better, which doesn't seem to be a distant thing anymore. But then on the other side, you've seen other corporates in the same industry slashing the budgets by 30, 40, 50%. So it's an interesting observation how corporates that are working in the same sector react differently. And that shows you, I believe that tells you a lot about the culture within that company. How much does innovation actually mean to them? And obviously, what kind of cash position do they have, et cetera, et cetera. So there's a bit of a context to consider. But generally, this is a very interesting view development we've seen. And then, of course, the money that's been lent from the governments to the startups and the actions the startups themselves took in order to make it over the last few years.
Right, that's obviously a really interesting point, because one would think that especially industries that were really hard hit by, say, the pandemic, like travel, would sort of be one note when it comes to their moves and their innovation. But really interesting point there. Would you say that any sectors or industries in particular have really outshined the pack when it comes to startup openings?
Outshining the pack. I like the way you framed it, actually. So yes, there were a lot of sectors have benefited from the last 2 years, but I think the ones outshining the pack were certainly the ones around food tech. So delivery of food We've seen Deliveroo obviously gaining a lot of market share, and then a lot of startups popping up in terms of instant grocery delivery, 15-minute deliveries, etc. And they've popped up everywhere, and they've received the biggest amount of funding. I think they're one of the German startups, Gorillas. They achieved unicorn status within less than a year, which was mad to see, and that during the pandemic, right? So we have food tech on one side, and then of course, I think that doesn't come as a surprise, anything related to health tech, telemedicine. We've seen a startup actually developing the vaccine at the beginning of the pandemic, or like being the biggest driver there. And then two more sectors which I believe were a bit more of a surprise: insurtech. A lot of insurance companies and the incumbents, as they're called, they really had to step up the game, and they really had to start working on their customer experience and becoming more digital. So insurtech certainly was a big winner. And then another one is, of course, fintech. Fintechs have been very popular anyways, but they had a big push with the move towards cashless society, cashless payments, etc., etc. And then we've seen obviously the move towards let's say sustainable finance, tracking your carbon footprint through your investments, how much impact do you have, and also becoming more inclusive. And that links back to the pandemic, because it's one thing to become digital as a company, but are your customers ready? So if I were to ask my grandma to use an app to do her banking, that's not going to work. So how can you make it more inclusive and for the elderly, for instance? And there was a big shift towards those solutions as well.
Right. Well, Gene, it sounds like what you're saying here is that the common denominator is technological development and digitization as well across all these sectors. Is that fair to say?
Yes, that's absolutely spot on.
And speaking of tech itself, are there any emerging tech trends that you foresee for the coming year?
That's a very interesting question, and you might get different answers from different people. But me personally, and also I guess based on what we've seen at Early Metrics, I think the major trends, I think the three main trends are the metaverse, and of course we've seen it. I believe the metaverse has always been linked to crypto lately, but there's more to it. Metaverse in terms of gaming, but also how corporates can leverage the metaverse to improve the customer experience. So we've seen a lot of retail companies or our retail clients who are sort of asked us to develop insights in terms of what's happening in the metaverse and how can they leverage this technology to create a better customer experience and actually, of course, at the end of the day, generate more revenue. Then the second one, I believe, is ESG. ESG is becoming increasingly important for investors, but also for corporates. We've seen investors waiving or passing an investment round because certain startups didn't meet specific ESG criteria. And the issue in this market at the moment is there is no standard for startups and how to rate or score a startup based on their ESG scores, because again, they are at a different stage compared to a listed company. So we're essentially seeing a huge demand for startup ESG ratings, which we're trying to which we've delved into already last year. And then the third one, and I believe this doesn't come as a surprise, is a bit of clean tech / sustainable innovation / climate change. We've seen a huge increase in investments into clean tech, and I mean, climate change is a thing. So a lot of startups that are tackling those issues are seeing increasing investments, and we believe this is going to be the next big thing, or continue to be the next big thing, amongst two others I've mentioned.
That's great to hear. I think you're really spot on about those tech trend predictions. And is it at all affecting perhaps your analysis with Early Metrics? Are you sort of really focused on breaking down these evaluations in terms of ESG, in terms of clean green tech?
It's a great question again. And yes, we are. Essentially, due to the market demand, we've developed a startup specific ESG rating, because what we've seen in the market, and those were also complaints from our customers, were that the ESG solutions on the market are out there. They apply to public companies, but it's not a one size fits all approach. Startups, they don't have the resources. It's not their priority to sort of focus on ESG. So we've developed essentially a rating that tackles or sort of considers where they are, what stage they are, and also what kind of initiatives they essentially have further down the line. So it's a bit fairer and more, let's say, accurate in terms of rating the startups.
Right, well, that is great to hear, and that's exactly what you want, especially as a corporate, I can imagine. So it's excellent that you've hit the nail right on the head there.
Yes, it's been received very nicely or well by the market.
I'm not surprised. Sounds like you're doing some excellent work there at Early Metrics. And well, with that, Gene, I've got to say thanks very much for joining us today on Executive Corner Expert Talks. It's been terrific to hear insights.
Thank you for having me, and it's been a pleasure.
Pleasure to have you on as well. And thanks for your time as well, viewers. If you've just joined us, that was Gene Darien of Early Metrics. As we say here, stay apprised and invest wise with Kalkine.